Welcome to Trading Nation. I'm Sara Eisen. First quarter earnings are up an eye-popping 25%. So why isn't the stock market impressed? We are joined by John Stoltzfus, Chief Investment Strategist at Oppenheimer. John, as a bull on the market, which I know you are, you must be frustrated. Why the disconnect?
Well, I think the disconnect around all of this really lies around the fact that we've got great earnings, but 25% earnings growth. And everybody's saying, well, that looks like it. Peak earnings growth. So what's next? Concerns related to the potential for protectionism to spread, for trouble with China related to a trade war, questions in terms of inflation in the Fed, you name it. But we think that improved earnings will prevail, even if in the quarters that follow we see a reduction in terms of earnings growth. So long as we get this double-digit type of earnings growth, or at least high singles, we should be okay.
What are you getting from the guidance from companies as far as whether that kind of earnings growth can continue?
I would say the overall feel is that managements at most corporations that are reporting, even if they've blown the doors off current results, are guiding reasonably looking ahead. I think that managements today have significant experience in the post-crisis environment with those things that we've often talked about, the robotics, the algorithms, the increased global competition as technology and globalization lowers it fills the moats, let me put it that way, and lowers the barriers to competition. All of that is counterinflationary, and also the risks that are very clear in most industries of overcapacity.
So the market has had a pretty decent 2 sessions following the release of a jobs report, which many said was a Goldilocks report. Good job growth, decent job growth, better unemployment rate, and yet no real signs of runaway inflation. Is that the catalyst, do you think, here that'll keep the rally going?
I think it helps preserve a more positive mode on stocks. But I think that what will really move and support the rally, if it's going to be extended, will be some kind of resolution or leaning, an environment leading towards resolution, whether it's NAFTA, whether it's in talks with the Chinese, anything at a fairly high level that would give us an idea that substance is winning over rhetoric. That could be a really important thing for the market.
So within the market, which sectors do you like?
Sarah, we like technology, we like industrials, we like financials, and we like consumer discretionary.
Everything's cyclical.
Everything's cyclical. Our underweights include utilities, telecoms, because of their bond proxy aspects. But we also have to admit that we are underweight energy. But within the S&P 500, we suggest about a 4.5% weight versus a 6% weight. So we're involved.
So you don't buy this idea that it's, you mentioned peak earnings. What about peak economic growth, that this is as good as it gets?
Oh, no, I think we've got better growth coming, but modestly better. I don't think we're going to see rapid growth here because of the effects of technology, globalization, and overcapacity. All of that has to be balanced requires more responsibility, less risk of irrational exuberance, less reliance on animal spirits, and harder work by everybody involved.
All right, a dose of optimism, John. Thank you very much. Good to see you.
Thanks, Sarah.
John Stoltzfus of Oppenheimer. Thank you all for watching Trading Nation. I'm Sara Eisen. We'll see you next time.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.